A brokerage firm is a company that helps people buy and sell securities like stocks and bonds. They act as the middleman in financial transactions. And capital? This refers to money or financial resources used by businesses to fund operations and growth. It can come from investments, loans, or retained earnings. Now let's talk about cash and cash flow. Cash is straightforward. It's the money you have on hand. Cash flow is the movement of money in and out of a business. Positive cash flow means more money is coming in than going out, while negative cash flow means the opposite. Ever heard of collateral? It's an asset pledged as security for a loan. If you can't repay the loan, the lender can take the collateral to recover their money. And a commercial bank is a financial institution that offers services like loans, savings accounts, and checking accounts to individuals and businesses. Let's break down compound interest. This is interest calculated on both the initial principal and the interest that has already been added. Basically, your money grows faster because you earn interest on your interest. Credit analysis, on the other hand, is the process of evaluating a borrower's ability to repay a loan. Lenders use this to decide whether to approve a loan or not. A credit union is a non-profit financial institution owned by its members. It offers similar services to a bank, but often with lower fees and better interest rates. Debt financing is when a business raises money by borrowing, like taking out a loan or issuing bonds. The debt-to-equity ratio measures a company's financial leverage. It's calculated by dividing total debt by total equity. A higher ratio means the company relies more on debt than equity. Speaking of equity, it represents the ownership value in a company after subtracting liabilities from assets. Two key terms in economics are the federal funds rate and the Federal Reserve discount rate. The federal funds rate is the interest rate at which banks lend to each other overnight. The Federal Reserve discount rate is the rate at which banks borrow money directly from the Federal Reserve. Both rates influence overall economic activity and monetary policy. And fiscal policy? That's the government's use of taxes and spending to influence the economy. Finally, let's tackle stocks, bonds, and initial public offerings, or IPOs. Stocks represent ownership in a company. When you buy a stock, you own a piece of that business. Bonds are loans you give to companies or governments in exchange for interest payments. An IPO is when a private company offers its stock to the public for the first time. It's how companies raise money to expand. That's it for today's session. We've covered a lot of ground, but these terms are key building blocks for understanding the world of business and finance. Keep learning, keep growing, and don't forget to apply these concepts in real-world scenarios. Thanks for watching, and I'll see you next time.